Macquaire as she goes, but for the nifty IT. Thanks for tuning into Talking Point. I'm your host Neeraj Shah, and it looks very quiet, like I said, but for the nifty IT. Yesterday, for example, it was the healthcare space which was holding out. In today's session, it's just IT which is holding out. Must say though, VIX has cooled off a little bit, if that is any solace to somebody who's buying in. What's corrected quite strongly are some of the result boys. So Piramal Enterprises is down about 7.5. HEG is down about 6.5 or thereabouts. There is weakness in Ratnamani Metals, about 4.5%, MTAR Tech about 4%, Hero MotoCorp corrects 4%, and this is despite rural commentary looking okay. Yesterday's result boy SKF is down about 6% or 4% as well. So those are a few names that have looked really wobbly in the session today. What has looked okay, PB Fintech has had a 10% uptick in the session today. SJVN on account of fairly robust set of numbers up about 7.5%. There is strength in Philips Carbon Black or PCBL yet again. And what a story that stock has woven for itself in the last few weeks. If you look at the 1 month chart for PCBL maybe, you will see, you'll get a sense of what I'm trying to say. It's had a really strong run, about 42% uptick in that stock in the last 1 month alone. So in some sense, some of the stocks are really flying around in trade. What's been a bit of a surprise to me, because I thought the gold loan guidance numbers looked okay, was Manappuram and Muthoot, and Manappuram in particular down about 1.25% or 1.5%, or in fact now Muthoot down 3.5%, and Manappuram too about 3% lower. So much unlike how I thought they would, the stocks have completely given way and down about 3% apiece. So that's one thing that turned out pretty wrong in the assessment, at least my assessment. What's turned out right, of course, is a clutch of other names, and especially the ones which have lost out in trade. In a bit, we'll be joined by Aditya Suresh, Managing Director and Head of India Research at Macquarie Capital, to talk about their sense and the fact that, or rather the belief or a hypothesis that the closer we are to a Fed rate cut, should the markets be a lot less anxious. The case for a chat with Aditya is precisely that. One, about the global macro. Two, FPIs unenthused despite India's rising weight, and why is that the case? And whether earnings are matching up to the valuation premiums in light of the fact that domestic flows are steady. Aditya, great having you. Thanks for taking the time out. I hope all is well. It's been a while, but good to be talking to you today. In advance to you and team, a very happy Independence Day.
It's always a pleasure to speak to you.
Thank you. Thank you so much. So Aditya, let's start off with this point. Since COVID lows, the principal mover of risk assets has been the Fed. We are very close, or we are closer than what we were 10 days back to the September meet, where presumably there will be some bit of rate action from the Fed. At least the markets would want to believe that right now. Should the markets be nervous in anticipation, or do you expect a risk-on of sorts in risk assets because of that?
I think from an India perspective, Neeraj, if I just frame this a little bit, the broader dynamic is that domestic flows and what's really impacting domestic flows has been far bigger of a support factor here for our market. So as a case in point, for example, when you look at the cumulative data, fiscal 22 to fiscal 25 so far, foreign flows have been about, say, $5 billion cumulative. We saw almost that scale of flows this last month from domestic mutual funds, right? So I think what's really going to happen to domestic flows is far more of an explanatory factor here for our market. It is at least our base case expectation that the RBI probably holds ground in the next 2 quarters. We'll see kind of how they respond to any potential Fed actions, but at least for now, our base case is that the RBI holds ground. So I'm looking at the domestic flow dynamic far stronger, Neeraj, of our closer than necessarily the Fed actions here.
No, which is fine, Aditya, but do you reckon that a Fed rate cut, if it were to happen in September, might just spur sentiment globally for equities by and large, and could that be constructive? Because, I mean, I was just looking at charts since 2020, and there has been, if not a near mirror image, then not a near perfect correlation, then a fairly strong degree of correlation between Fed action and global markets movements. Of course, other different markets would react to it in different percentages, but the direction broadly has been similar.
Yeah, I think that's probably a pattern to kind of play out as well, right? Now, I think there's an element of why is the Fed cutting, or why could the Fed cut, and is that more a sign of caution, or we will see, right? Now, I think in general, could there be like some sort of positive sentiment to the extent that the Fed were to cut? We buy into that.
Okay, okay. Let's talk about flows, Aditya, since you spoke about domestic flows, but I'm more inclined to understand from you because you guys have such great experience with regards to what global clients might be thinking like. What is your messaging to clients when you talk to them about the India story currently? And what is their feedback, particularly because we haven't, or we are definitely not the recipient of flows. Is it an EM thing? Is it an India specific thing? If it is an India specific thing, why do you think this is happening?
Yeah, I think that's a good starting point, right? Which is that it's not necessarily been the case that India has been a benefactor of the China diversification flows. As you pointed out, for example, when you go back and look at the data in that sharp sell-off period for China between 21 and 22, overall MSCI emerging markets ex of China saw outflows. When that India also saw outflows on an absolute basis. In 2023, that category EMX China saw inflows, and within that India captured a stronger share of those inflows. So that was supportive. But so far this year, as you point out, flows have been inconsistent, and it's been about neutral. So in terms of the broader kind of the foreign kind of funds, etc., the key stumbling block remains clearly valuations and headline valuations. Our submission on this topic is that the headline is likely to remain, at least on relative terms, elevated. And the reason why it remains elevated is more about what's happening locally in terms of domestic liquidity. So the conclusion of one of our recent reports, which we kind of released, was that the question was, I mean, how long can these valuation premiums kind of last? But the real kind of substance and the crux of the note was that we think this India remains a rich bazaar, and these steep valuation premiums could exist, and these dislocations could exist because there's so much of domestic liquidity kind of chase up these assets. But it's a tough one. The foreigners, there is clearly a dynamic here where headline valuations was a stumbling block, say even 12 months back. It's become even bigger of a stumbling block today.
Okay, so let me try and ask you something that I was trying to ask yesterday to Manish Chokhani as well, Aditya. Everybody who looks at the Indian markets in the last 2-3 years, relative to what's happened in the past. In the past, the most common argument was at some point of time when the markets reach these stratospheric valuations, and so on and so forth, and if there are bad news, the markets would correct quite significantly. Is the template of the market, because of the local liquidity, slightly different this time in the way bottoms are formed very quickly, or markets don't correct at all? Part one of my question is that. Part two is this, that typically if markets used to correct because of factors, at some point of time, global flows would come in when the valuations would become cheaper, and that would be the bouncing board for the market. This time around, could it happen that global investors may not get the markets too cheap in India because the local flows are consistent month on month and they are not ebbing?
Yeah, I think the way you described it is largely kind of is our view, right? So, but just to articulate some of the risk factors, right? What are we facing here at these high valuations? So across measures, whether it be India versus itself or India versus emerging markets, take your pick on how you measure this. Will be about 2 to 3 standard deviations above normal. There is no kind of escaping that factor. Now, we don't sit here and say that that's going to mean revert. And we don't think mean reverts because of the domestic liquidity dynamics, which you spoke about. But just before I get into the domestic liquidity piece, which I strongly buy into, some of the key points as risk, which we think about, which we still need to work through, and so why a potential kind of pullback can't be ruled out clearly, is that when you look at earnings estimates, there's clearly fatigue across sectors and consensus. I think we are overstretched. That's point one. Our growth premium compared to emerging markets that meaningfully kind of compressed. Typically, that used to be about a 500 basis points, rates about zero. I think it's interesting to observe that insiders have been cashing in, right? Whether it be MNCs, the PE investors, so on and so forth. And only about, say, 5 to 10% of this cashing in is being for growth capex. So all those kind of are points of concern here for us. Typically, what we have said then in the face of the high valuations and these concerns, that we should be as a market trading far below where we are today. These are catalysts enough to kind of cause that kind of compression. But even in your in the past few days, what we've seen is that whilst the entire domestic liquidity theme, Neeraj, is, I think, well appreciated, the sheer scale and magnitude has clearly been surprising on the upside. And just to kind of reiterate the same point, that just like what we saw last month, just for perspective, is worth what we saw as foreign flows on a cumulative basis over 3 years, 1 month, right? And so I think it just
Sorry, Aditya, care to repeat that? Care to repeat that, please? And the significance of this, yes.
Yeah. So what I was trying to get at is just last month, the July data in terms of what AMFI kind of publishes, etc. What we saw as net inflows to equity markets just in 1 month was worth almost what we saw as cumulative flows over a 3-year period from foreigners. Wow. That, I think, is kind of the real kind of case in point here, where the pace of these flows, the stickiness, the magnitude, all this is surprising us on the upside. Now, that's only part one of the equation, right? So one is just that entire financialization of savings dynamic, and that's more from the retail participants, whether that be through direct or indirect kind of allocations. But then also you saw in the past couple of days how LIC is speaking about them kind of allocating close to about $20 billion to equity markets this year. That's incremental flows, right? Then you look at the EPFO data. The EPFO mandate allows for 15% to be allocated to markets. We're sitting under that limit. So in addition to kind of retail participation, whether it be direct or through mutual funds, then the LIC piece, then the kind of EPFO piece, a lot of this flow is not really reacting or responding to headline PE multiples. They're more allocation choices, right? And so that theme in itself, I think, has legs to go. So therefore, in our recent piece, what we basically concluded was that whilst there are reasons to be cautious, and there are several reasons to be cautious, given where headline valuations are at, and therefore a drawdown is likely. Our view is that these drawdowns would be bought back, right? Given the strength of this liquidity dynamic.
It's very difficult to predict, Aditya, but could the extent of the drawdowns be shallower? Are you putting percentage terms to this? I know it's hazardous to lay out a guess, but I'm still trying to understand.
Yeah, I think it's hazardous. I think that's kind of our position as well, given that it's all liquidity, supply, demand. I mean, I can get my head around trying to price something based on return on equity growth. Therefore, the multiple should be X, right? And then trying to make sense in terms of how much downside there is, so on and so forth. But really what we're speaking about is significant compression of the cost of capital. And that compression of the cost of capital, because domestic liquidity is having these profound valuation impacts. And we are calibrating as we go, right? Rather than actually calling for a specific drawdown, rather than calling for specific drawdowns.
Got it. Okay, viewers, here's another very interesting chart, and I just want to draw your attention. This is from the note that Aditya is referring to, which is the latest note. And just look at the 2-year forward ROE outlook of India versus other emerging markets. There's one more piece maybe added to this. Aditya spoke about return on equity in just the previous answer, that typically countries or companies with higher ROEs tend to get rewarded slightly more or maybe considerably more than others. And look at the ROE outlook of India versus other emerging markets as things stand right now and likely going ahead as well. It's always been high. For a period around COVID that shrunk, and it's again looking, as per the Macquarie view, some calculation and some outlook view, looks to be expanding. And I think what we'll do is, as we take that break, is that we will take a break right now, but on the other side of the break, we will ask Aditya Suresh about the significance of a comparatively higher ROE for Indian firms versus rest of Asia, and what would that lead foreigners to do in the event of a correction despite the higher valuations. I think that's something that I'm looking forward to hearing from Aditya Suresh. Stay tuned to this conversation on Talking Point. We'll be right back. Well, thanks for tuning back to Talking Point. And just before the break, I was mentioning the importance or significance of this to my mind, but I'd love to know, because this is from the Macquarie note, which Aditya Suresh has penned down. And Aditya, I would love to understand what is the significance of this higher ROE that India enjoys, because we know that during the past decade, a lot of commentators have said that that was a principal reason why India used to trade at a premium. Is this still a key reason for why India could stay at a premium, and therefore in the event of a correction, could this be one of the drawing factors as well?
Yeah, so just to explain the graph again, what we're showing you is, again, forward ROE expectations for consensus. And the point which we make is that in terms of an outlook, we are, as a market, set to improve from a 12% ROE outlook towards about a 16% number, which is constructive. Now, the significance of this is as what you were kind of pointing out, which is that I think quality stands out, right? So quality stands out as a support factor, and in particular, as a factor, it really stands out in the event of pullbacks more globally, right? So I think this would be a key characteristic which continues to be in India's favor. When you kind of overlay the fact that you have growth in the market as well, a lot of themes, so on and so forth, this entire quality compounding characteristic for the overall market will, again, I think, be a support factor here for us right? Now, just on the premium in itself compared to emerging markets, today is about 300 basis points. By that, what I mean is, if India is at 16%, emerging markets, the expectation is about, say, 13%. That 300 basis points premium in itself is not too dissimilar from history, though. So whilst it is a support factor, Neeraj, is it an explanatory factor to suggest why India is sitting at 22 times 2-year forward multiples? It's not. So it goes into the mix, but just on growth, just on returns, these are helpful, but they don't really tell you the full story. It still comes back to, at least empirically, when in the note we kind of go through this in detail, is that just in growth, just in returns, just in foreign flows, we can't really defend why, as a market, we should be at these levels. But then when you kind of think about the domestic liquidity piece, it then kind of comes together, and we can kind of, these valuations start to make more sense.
Okay. But so that, agreed, it's a mix. Obviously, it won't be a single biggest factor, but as important, I mean, is that a strong enough important reason, coupled with the fact, Aditya, that now, again, as one of the other charts in your report shows, India's weightage in the EM basket as well for passive flows too, right? Much higher than what it used to be, the differential much lower versus China. So whenever the EM flows gush back, presumably post the rate cut or otherwise, does that also aid the probability of flows? So higher ROEs, more weightage, stable earnings growth, does all of this augur well for flows? I'm just trying to understand from somebody who looks at this more closely and is more informed than most people about when do foreign flows make a comeback.
But I think that's exactly it, right? So I don't think India on its own, at least in terms of foreign liquidity dynamic, just going back to 2023, right? Yes, we saw a lot of flows coming in, But the backdrop was that EM ex China as a group saw a lot of inflows, and within that we saw a greater capture of those flows. Right. So I think the starting point has to be that EM ex China as a category is going to see more inflows, and within that, I think India will continue to stand out as a benefactor of these benefactor of these flows. But I think as a category, as a group, we've got to see the inflows first. I don't think India on its own is going to see foreign allocations expanding, at least from foreigners.
Got it. Okay. Aditya, where do you think money flows in? I mean, what is the top sectoral thematic bets that Macquarie is laying out at the current valuations?
So if the question is about the foreigners, the problem has been that
No, I'm sorry, Aditya. Aditya, actually, the question is really about what is in your head, what is it that you think are the best bets? I don't know if you are essentially looking at strategy, thinking about those lines, but if you are, would love to know that.
Yeah. So when you kind of tie all this back in to the bottom up, thinking about what's in earnings expectations, where's the risk, so on and so forth. As a general point, Neeraj, what I'll make is that we're finding that sector type of top-down call much harder to take today than what it was, say, a couple of years back, where we could have given you some view about financials and industrials, all these things. Today, at a point in time, we're not seeing clearly any of the sectors where earnings estimates is going to be revised upward. So if I was using that as a proxy to think about where should we be incrementally positioned over the next 12 months, our honest submission is that across sectors, estimates are full. Within that backdrop, then it becomes about where in relative terms do we see or have a bit more confidence compared to consensus on how these estimates could shake up, and then kind of overlaying valuations as well. So the private sector banks looks really interesting, given the steep valuation disconnect here. Whilst we still think that there are compounding characteristics. Beyond that, I think the telecom sector has done well. I still think there's a path where the incremental returns are going to meaningfully improve over the next 2-3 years. The IT sector, I think, is one where, if anything, we're probably a bit more optimistic than where the street is at on both the recovery as well as margins. And that's kind of one where positioning is relatively mild as well. So if you want a contrarian-ish kind of couple, it's more the IT space where we'd be allocating. But I think the real message which I wanted to give you was that it's more bottom-up, specific stocks, and then kind of and then aggregating it up rather than starting with a view that I want to be overweight financials or IT or industrials.
Point well noted. Anything that you believe, I mean, where there is a clear case of caution warranted? I mean, we were covering one of the conferences, investor conferences, and one of the summations was that rural demand is picking up, urban is slowing down. Are you guys kind of thinking on those lines as well, and are there investing implications thereof?
I think consumer as a space, we have remained cautious for some time. Given where earnings expectations are at, I think there are disappointments to potentially kind of work through. For example, as a case in point with the auto sector, when you kind of look at estimates, what's in estimates is volume growth, operating leverage, margin expansion, right? That's the kind of outlook over the next, say, a couple of years. On a real-time basis, what we can clearly see is inventory levels increasing. And in response to those inventory levels, you are seeing kind of price action and price cuts, right? So that clearly speaks to downside to earnings estimates. So I think just to kind of the case in point, as you're speaking about with consumer, I think that's an area where we are remaining cautious. And it's if there is any positioning, it's very selective and bottom up. Even the rural dynamic, it's not amply clear to us how much of this is actually going to sustain in the next, say, 6 months to 12 months. At least the data is not as yet fully kind of formed and supportive. I think for now it's still a view that we think conditions have improved. Hopefully it sustains. But when I look at, say, real rural wage growth as a proxy for this, that's still soft. And so you really need that to kind of pick up for us to gain more confidence on this rural recovery story.
Aditya, so good talking to you. Lovely note. Thanks for writing it. Thanks for sharing it with us. And thanks for talking about it with us. Appreciate you taking the time out today.
Thank you, Neeraj. Fantastic.
Yep. And well, viewers, on the note that the markets are lying quiet today, maybe a bit of, it's a very flat move, and courtesy IT, because which is piling on its weight, up about 1% as we wrap up this edition of Talking Point. Thanks so much for tuning in.